Well, it was a nice bounce back day on Wall Street today as we did see all of the indices up over 1%. We even saw the NASDAQ and the Russell 2000 up over 2%. The downside is that we still didn't make up for the losses that we had just yesterday. So we have a lot of work to do before this malaise is officially over. In fact, we still have a bearish posture on all four major market indices, even after today's rally. Who knows when that'll change, but we are in the heart of earnings season. We've got Amazon and Intel and Chipotle and others coming out after the bell tonight, so maybe we'll take a peek at those. And we'll also see some of the technical damage on other charts as we go through our process tonight. And then we'll end with a trade application on a spicy candidate that has been bucking the market trend here recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 25th, 2018. First of all, if you're new, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can go to YouTube and subscribe to our YouTube channel. While you're there, check out our description area. You can sign up for our email distribution list there. That'll also entitle you to seeing the stocks that are giving you overbought and oversold cluster signals in the S&P 500. We're also heavy users of Twitter. Make sure you're following us there. My handle is @BrandonVanZ. And if you ever see these Market Outlook posts out there, we'd appreciate it if you click like and retweet if you get value out of these free daily videos and you want them to continue. We also have a Facebook group established, so make sure you check out our group web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the analysis for tonight. As you can see, I've got chart 4B pulled up here for those of you that are premium Market Scholars subscribers if you want to follow along with my presentation tonight. These charts that you see in front of you, there's four different charts here. The chart in the upper left, the S&P 500. The chart in the upper right is the Dow Jones. Chart in the lower left is the NASDAQ composite. And then the chart in the lower right is the Russell 2000. Now, the key takeaway here is that as you look at the color that is displayed all the way to the right of each of those four charts, they remain pink. Not only that, but dark pink, which tells us that we have strongly bearish postures across the board despite today's nice bounce back rally. In terms of how extreme the rallies were today, let's go through the charts. You can see the S&P 500 was up 1.8% today. So that ended the 6-day down streak that we had there. In fact, I saw on Twitter last night, that was actually the second 6-day losing streak for the S&P 500 in the month of October, and that's never happened in history before. So we are in some pretty precarious times right now. This is not normal price action, but we're surviving, and so we're looking for opportunities out there. You can see the Dow Jones was up 1.6% today. But it has not gotten beat up quite as bad as some of the other indices. Some of those that have been beat up a little bit more. Down below here, we got the NASDAQ composite. It was up almost 3% today. It was up 2.95%. So a wonderful snapback rally there for the NASDAQ. Part of that was on the backs of some earnings reports that came out. For instance, Microsoft had a very good number here. We also see that the Russell 2000 had a nice day. It was up about 2%, and we're right at that psychologically important $1,500 level at the close here. So that's where we stand. But again, the key takeaway is let's not get overly excited about the one-day push higher. Our postures do still remain bearish. So make sure that you're managing your accounts appropriately. If you're looking for trade ideas, perhaps some bearish trades are showing up for you. Otherwise, if you are a long-only investor, make sure you're position sizing appropriately or focusing on the right sectors that are out there. Remember, there are some defensive areas of the market that are actually holding up there pretty good. Let's take a look at a few more charts here. I'm going to go to chart 4C. Here we're going to look at the same four indices, again looking at 3 months in length on each of them, but here we're looking at the 3 green arrows method, and we're just trying to determine whether we have 3 green arrows, 3 red arrows, or a mix. And as you can see, we've got 3 red arrows in all 4 of these charts cases. Reason we know that is we can see the pink background color all the way off to the right-hand side. For those of you that are not familiar with that term, 3 green arrows or 3 red arrows, we're basically looking at technical indicators, 3 different technical indicators. The top one would be the 30-day moving average on this chart. When price crosses below that moving average, it generates a red arrow. Then we have the MACD kind of in the middle. The MACD is also kind of incorporating moving averages to a degree. Its official name is moving average convergence divergence. But really what it's trying to do is gain a sense of whether the more sensitive moving averages are moving faster than the less sensitive ones, to kind of give us a heads up on what's happening with momentum of the market. So right now, we do have that red arrow in place on all of those charts as well, telling us that we don't have positive momentum at the current juncture. If anything, we have negative price momentum. And then lastly, we also look at the stochastics. You'll notice, for instance, here on the Dow Jones, we have what's known as a phantom red arrow. And stochastic is out there to measure where a stock is closing, or in this case, an index or an ETF, is closing in relationship to its recent trading range. And so with the thought process of if you want to be bullish in the markets, you'd like to see us closing near the highs of most of the recent candles. And of course, that has not been the case, which is why we have the red arrows there on the stochastic. So across the board, not only do we retain bearish postures on all four of these indices, but we also have 3 red arrows on all 4 of these indices. So again, not exactly a great market environment that we find ourselves in right now. The 1040 crossover method is a little bit longer term in nature. I talked about this a little bit more on my video on Tuesday, so I won't belabor the point. But the one that we do have the most fear on right now is the Russell 2000. Notice that this orange moving average is about ready to cross below that blue moving average. We call this our 1040 crossover method, and we're applying it to a weekly candle chart, so it's very similar to a 50-day, 200-day moving average. Sometimes you'll hear that referred to as death cross and golden cross. Well, we're about ready to have a death cross on the Russell 2000. The other indices are holding up just fine. We don't have any fears of crossing over here this week on the other 3, but on the Russell 2000, it's possible. Let's maximize this sell. If we have a really horrible day tomorrow, remember, tomorrow will be the last day of the week, so that's when we can confirm whether we have a crossover or not, since we're using weekly candles here. But if we have a really terrible day tomorrow, it's possible it could pull this orange line, the 10-period moving average, down below this 40-period moving average right here. I suspect that it's not going to happen, but then again, sometimes Fridays can get a little bit chaotic towards the end of the day as investors decide they don't really want to hold stocks over the weekend. So I definitely won't say it's not possible. I'm just going to say it's probably a little bit too there needs to be too much of a move in order to have a crossover right there. So in all likelihood, the crossover will have to wait another week. But then the probabilities of that taking place, I would say, would be very strong. You would need a pretty fast snapback rally in coming weeks for it not to cross over. So it looks to me like the Russell 2000 will be our first death cross of the 4. But I suspect that it's not going to happen this week. It'll probably happen next week or the week after. And if that's the case, then the idea there is that the posture, the longer term posture, would be a little bit more bearish at that point. And for those of you that have more passive money in a fund that tracks small caps, you might want to kind of have a second opinion about whether you want to continue that or not, depending on your thought process going forward. We've had a very nice run with the Russell 2000 and all indices really since 2016, as you can see here in that bullish territory. So if this is the time for us to go back to this pink background, so be it. Let's take a look at a few more charts here. Let's take a peek here now at our chart 4E, and this is our intermarket analysis 12 grid. And remember, the background colors of these charts will tell you whether we have a bullish or bearish posture using the intermediate term line on the market forecast indicator. So the VIX has been something that we've all been watching here recently with interest due to the nice push higher in the volatility index when stocks start cratering. But you will notice that we were down 4% in the VIX here today. Again, a lot of times that's inversely correlated to the market. So with the market being up today, not a surprise to see the VIX down, but it does remain at elevated levels. Remember what that means for your potential options trades out there. If you are selling premium, sometimes having higher volatility is actually a good thing if you expect that to kind of dissipate as the months go on. When we look at some of these other charts here, I'm really just looking for either key trends or reversals of trends. And one of the things that we've been talking about lately is strength in certain commodities. Now, gold has been the one that has been the most interesting to me because gold had been in a long-term funk and all of a sudden starts to act a little bit more interesting here in the last 3 weeks or so. And of course, it's no coincidence that that's when the stock market itself has started to get a little bit dicey. And we will find that on occasion where, the prevailing wisdom is that when markets get chaotic, money is trying to seek out a place of safety. And there are times when gold is viewed as a safe haven asset. And so I think that's what we're seeing out of gold right now. The reason I say that is because the dollar is actually strong. Remember, sometimes commodities are moving just simply because the US dollar is going in one direction or the other. But typically when the US dollar is strong, commodities are weak. So in this case, we're actually seeing a very nice bounce for the UUP off the moving average in the last couple of weeks. And at the same time, a key commodity here in the form of gold is actually rallying. So I think gold is collecting some investment dollars as a safe haven asset class, not necessarily because it happens to be a commodity. You'll notice what's happening with crude oil over here. Crude oil has been getting blitzed here in the last couple of weeks as the US dollar has been going up, and that's a little bit more of your natural relationship there. Crude oil was up today, but just ever so slightly. It was up 0.36%. Now keep in mind context here. We went from overbought conditions with this red dot all the way to oversold conditions with this green dot. So today's rally of 0.36 or 37% is very, very modest, to put it nicely. In other words, you would have expected a much bigger snapback rally if this was going to be the start of something big. Let's go ahead and take a peek here now at our next chart, which will be our foreign stock markets. This is chart 4F for those of you that are premium market scholars following along at home. Well, we've got a little bit more beneficial news here than I had on Tuesday when I went through these charts. Tuesday, the only green chart we had on the board was Brazil. Lo and behold, look what's happening over here. China. China's the second chart to show up in the green now. Now, just because it's in the green does not necessarily mean that it's going to be a great bullish trade. Perhaps one to kind of put on a watch list and see how it behaves. If you look at the difference between Brazil and China, Brazil remains above a rising moving average, whereas China remains below a falling moving average. So this could be temporary in nature with China. Of course, there's a lot of headline risk there with everything that's going on with trade wars and tariffs and everything like that. So just be aware that there is some stability finally coming to China, where we've stabilized around this level here. So perhaps the selling that occurred earlier got a little bit overdone, and it's just trying to unwind some of that tremendous bearishness that occurred before. But just because it went to a bullish posture on the market forecast doesn't necessarily mean that this is the best looking chart or trade out there. I would still say that Brazil looks quite a bit better in that case. Otherwise, we do have mostly bearish postures across the board. We did have an interesting development here on Israel today. Israel did get an oversold cluster signal, and so did Canada. Excuse me, so did Canada, by the way. You'll notice right here. So a couple of those countries, despite being up today, and you don't see that a lot. So Israel was up 0.84%. Canada was up 0.04%. So on days where they were up, they actually got oversold cluster signals. That goes to show you how ugly things had been in the days leading up till today. So perhaps we're getting closer to the end of this downdraft here, at least in the near term. Let's go ahead and take a look now at our 12 grid for the U.S. sectors. And as we pull this up here, you can see that we've structured those bullish postures mostly down here on this bottom rung. We've got the staples, we've got the utilities, and we've got the real estate. Now, one thing that ties all three of those together is they're all interest rate sensitive to one degree or another. Remember, those are some of the areas where you find the best dividend payments, and oftentimes those sectors are viewed as bond-like proxies. So what you find is that when markets get a bit chaotic, interest rates do not go up as fast, and in many cases they go down because money is fleeing from the stock market into the bond market. And it's in an environment like that where the defensive areas like your utilities, REITs, and staples can hold up a lot better than the rest of the market that is much more cyclical in nature. Now, to technology's credit, that's somewhat of a surprise up here. Technology actually went back and reverted to a bullish posture here. Again, be careful with that mentality because we're way below this moving average here, but perhaps we can get a reversion to the mean mini pop towards that direction here. A lot of it will depend on what's going on with earnings here. These other ones are looking a little bit more firm, right? The staples, the utilities, and real estate are all above moving averages. Now, real estate finally got above the moving average just today, and it doesn't look quite as strong as utilities and staples, but nonetheless, it is good to know that in a time like this where it feels like the sky is falling and that, every single stock must be going down, that's actually not the case. There are some key consumer staples companies out there like Procter & Gamble that have been doing quite well in recent market activity. So, be on the lookout for those kind of maybe hidden bull markets that could be taking place under the surface while everybody else is pulling their hair out about the headlines that are affecting the general marketplace out there. Let's go ahead and take a peek here at some of the stocks that are reporting earnings tonight, because this is one of the biggest earnings days of the entire quarter. Some of the really big names out there are reporting. So you can see I've got this pulled up from Earnings Whispers here, and we're looking at this area that I'm circling. This is Thursday after the close. So you can see some of the names reporting tonight: Amazon, Snap, Google, Intel, Chipotle, Cypress, we've got Gilead, Western Digital, AK Steel, and Expedia. So let's go rattle through a few of those names there to see if any of them are showing stability after hours, or if perhaps we should expect some more selling. So I'm going to come over here to the trade tab, and I'm just going to pull up, let's pull up Google to start off with. That was one of the stocks that was reporting after hours. Now, this stock did close at about 11:03. At the close here today. You'll notice it is trading lower after hours. Right now the bid is 10.56, ask is 10.60. So this is a stock that is down about $40, not quite, but almost $40 per share there after hours. In fact, it is $40 per share. So Google is not going to do the market any favors, at least at first blush. Remember, some of these are very early after they've reported, and we've seen plenty of times where they have reversed course. But as of this exact moment in time, which is just over a half an hour after the market is closed, we do see Google nosediving there to a degree. Now, the last I checked with Amazon, it was doing the same thing. Let's see if that's still the case. Yeah, Amazon is not doing us any favors either. So Amazon, notice it closed at 17.82 on the normal session today. It is trading over $100 per share lower. Now, keep in mind that's a big base, so the percentage decrease probably doesn't sound quite as dramatic as saying it's down $100 per share. But nonetheless, that's where we stand right now. It's down fairly significantly. Those of you that have my chart setups and workspaces and things like that, remember you can use this chart in the middle here to identify normal market activity versus the after hours activity. The shaded part that you see right here is the after hours, and then the white is the normal hours. So you can see that we closed right here near the high of the session for Amazon, and then boom, right when earnings were reported, that thing just fell out of bed and has been trending lower. We're nearly at the after hour lows for Amazon right now. So that's not necessarily a good sign. Remember, it really started last quarter with Facebook. So FANG has been the story of this market for a long time. Of course, Facebook and Amazon, both part of that FANG, and so is Google. But Facebook just really laid an egg last quarter, and that really started to have a lot of that structural damage to those high-tech FANG-related names out there. And so that's not necessarily a good thing, because they were really one of the stalwarts of the market for years and years and years. It's not good when you take your generals out and shoot them, and that's kind of what's happening right now. So we're trying to find if there's going to be any replacement leadership names that are out there. And right now, maybe Microsoft, after their big earnings beat there, could be one of them. But otherwise, it's a little bit more difficult, especially in the technology-oriented or growth-oriented spaces, to find those big stalwart generals out there. Let's take a peek at a few others. Snap, although not nearly as big as Google or Amazon, is sometimes still an important barometer of social media activity. Snap is also down after hours. Now, it tried to rally. You can see Snap closed today basically at $7, and at one point after hours, it was up to $7.71. Remember, that would be a 10% move to the upside. but it's since reversed course completely and is now actually trading, about 20 cents lower than where it closed. So we're 0 for 3 here. All of these are down after hours. Intel was another one that was reporting. This one finally is one that is up. Now it's not up as much as it was. You'll notice that Intel was a $44.31 stock at the close today. It's currently trading at about $45.55. So we're up about $1.20. It's not half bad, but you will notice here that it did trade all the way up to $47.19 at the high after hours. So it has pulled back some degree in the after hours session. Let's take a peek at maybe one more and then continue our conversation. So I think Expedia was another big tech name that was on the list here tonight. So there's Expedia. And there we got a nice little beat, it looks like. We've got 117.57 at the close today. It's currently trading at closer to 126. So, that one's up a good $9 or so after hours. So a little bit of a mixed bag there, but on the whole, it's probably leaning a little bit more negative. Because Amazon and Google are such big market cap companies, they're going to have more influence than stocks like Expedia. So on the whole, we'll have to see what tomorrow morning brings. But right now, not a lot of positive price action out of those earnings reports. Okay, I wanted to take a quick peek here at what's going on with some of those sectors on a one-day basis. So let's go ahead and take a peek here at the sector ETFs and see who did what here in today's session. Remember, this was a risk-on day that's been hidden within a very disastrous market period. So a lot of times the stocks that do the best on these snapback days are the ones that got beat up the worst in the prior pullback. And that's kind of what we see here today. We've got communication, technology, discretionary, materials as our top four. The top three were actually all up over 2%, and even the materials were up 1.3%. So, those are the areas that are going to be more cyclical in nature, so it makes sense that they're snapping back the most. On the downside are some of those areas that have been holding up better recently, but they're the more boring defensive areas. And so you do have the utilities that were the only sector that was down today, but the staples, although they were up, they were the second worst performer. And so you kind of see that turn of that reversal of fortune to a degree amongst the sectors now that we had a snapback day for the first time in the last 7 days, I guess you could say. All right, so with that out of the way, let's go ahead and talk about our trade application example now. So for this, I was trying to find something that was bullish. I think Kramer says there's a bull market. There's always a bull market somewhere, something along those lines. But the point that he's trying to make is that, under the surface of what appears to be a bloodbath everywhere, there are actually hidden gems that exist out there that are kind of dancing to their own tune. And I think I found one of those here tonight as I was going through some stocks. So I want to bring up chart. Let's go to 4A here. And I mentioned in the intro this is going to be a spicy stock pick, and now you'll see why I referred to it as such. So this is McCormick, and now that you are all rolling your eyes at my attempt at a joke there, the spiciness comes from the fact that this company sells spices. And many of you are familiar with McCormick because they pretty much dominate the spice aisle at your local grocery store. But its business itself is not all that spicy, really. It's a consumer staple company that is generally quite boring, right? And that's actually what investors are seeking out intentionally right now. Remember, when the markets are firing on all cylinders, investors choose to avoid a lot of the most boring stocks to go into the most aggressive growth names out there. But when we see a market that starts to sell off fairly aggressively, like we've seen this month, a lot of times that kind of reverses course. And what we find is that money starts drifting back to where it perceives to be a little bit more defensive in nature. And that's what consumer staples generally represent. Now, McCormick is actually a dividend aristocrat company. So that means that it's in the S&P 500 and it has raised its dividends for 25 years in a row or more. But I want to emphasize right now that this would not be considered a dividend-oriented trade. So just want to be clear on that because sometimes people get confused. This is a stock that has gone up quite a bit, and therefore its yield is actually quite low. Its yield right now is only 1.49%. So I'm merely pointing out the fact that it's an aristocrat just for your back pocket knowledge there. But this is not one of those picks that you hear me talk about where I want to buy it here and hold it forever. Generally, we want to buy stocks on pullbacks and hold those ones for a long time if there's those high quality dividend raising companies. So this trade idea is going to be just a more of a trending momentum based idea for the short term. And for that, we're going to use options. You can see here clearly that this is a stock that is in a very strong uptrend, right? This is a 3-month daily candle chart here, and there's been very few days where you've had a bearish posture. The vast majority of time, including almost all of October, has been bullish. Now, you can't say that for a lot of stocks out there. The vast majority of stocks are stuck in a serious downtrend right now. This one is actually a very nice looking trend where we have well-defined higher highs and higher lows. Now, you will notice it pulled back today. Again, it was kind of a reversal day where money went back into things like technology and went out of things like staples. So this was down 1% today. But remember, sometimes that leads to an opportunity as well. Sometimes trends can get so hot that we feel like we don't have an opportunity to enter into them because they're never pulling back. So there is something called the bullish intermediate confirmation signal that we'll look for on the market forecast indicator. And we almost have that right now. Notice that the green line is in the upper reversal zone, so we would consider it to be bullish. What we need to have the bullish intermediate confirmation signal is to have the momentum line, the red line here, in the lower reversal zone at the same day that we have a bullish posture. So you'll notice that to the naked eye, it looks like that red line is actually in the lower reversal zone, or at least touching it. Remember, you can actually read the specific number right here in the label, and it says it's at 2052 and falling. So be aware that this isn't technically a bullish intermediate confirmation signal. It needed to fall a little bit more, but it still gives you that idea of understanding what that signal is trying to tell you. It's a buy the dips mentality. This has been a very strong stock that almost goes up every single day. Today was your first buy the dips type of a mentality that you could have tried to get in on it at a slight discount. So what we're going to try to do is we're going to try to sell a bull put spread on it. And so for that, I'm going to come over here to the trade tab, and I'm going to take a peek here at these contracts in December. The November ones, depending on the stock, could still be acceptable because a lot of stocks have really high volatility right now. But what I found is that, with a stock like a consumer staple company like this, it doesn't have a tremendous amount of volatility. And so you probably have to go out to the Decembers if you want to get a good return on your investment. But keep in mind the downside of that as well. You're in the trade for 57 days as opposed to 22. So in the end, there's no perfect way to handle that. But I do find this to be acceptable if you assume that this stock will continue to go up in its current uptrend. So for that, I'm going to come over here now to the put side of the equation on the December contracts with 57 days left until expiration. Now that I've done that, I'm going to come over here and look for the 135 put. And you can see that's right here. And you can see that that's about our 34 delta in this particular case for those of you that are hunting down deltas. A lot of times when we sell put spreads, our sold strike is around a 30 delta. So if I right click on that 135 put and I go to sell vertical, you can see that I would be able to generate a credit of $1.20 if I sold the 135 put and I bought the 130 put as part of this spread right here. So what you're hoping to accomplish when you make this type of a transaction is you want the stock's price to stay above the sold put strike price. So in this case, McCormick, that's trading close to $140 right now, we want it to stay above 135 if you want to make money on this particular trade. Now we're going to get a $1.20 credit, and remember, if you click confirm and send once, you can get your calculator out here and do the math. If you take 120, which is the max profit, divide it by max loss of 380, you can see that that's a 31% return on risk. So a lot of times we're trying to shoot for over a 30% return on risk. If we try to do this exact same spread in the November timeframe, unfortunately, it was a little bit less than 30%. So, in the end, like I said, there's no perfect way to handle this. But for those of you that don't want to be in this trade for 57 days and you'd prefer the 22 days instead, just understand that your return on risk is going to be less than what we're featuring right here. So again, the idea here is it's a bullish trade idea. And if we come over here to the charts, you're basically saying you want this stock that is in a clear uptrend to stay above 135 out into the December time period. And if that's something that you think is going to happen, then it could be an acceptable trade idea. So for that, let's go ahead and place the trade. I'm going to click confirm and send, review it one last time, and we'll go ahead and send that off. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. It was nice to see a brief bounce back rally today, but don't get overly excited about it. We still have bearish postures on most of the indices out there. However, there are certain places within the market that are holding up much better than other places, such as that consumer staple trade that I showed you there a moment ago. So remember to keep your head about you, keep yourself with a cool and collected mindset while everybody else is panicking around you, and best of success with your trades and your investments. Goodbye for now.